Hey folks, welcome back to the live stream. Yeah, I'm actually trying to do this almost every day now. I've been quite a bit busier than usual lately with some actual work I've had to do, unfortunately, and so it's been more difficult for me to make videos than it has been to talk live on a live stream. I know that seems a little bit odd. You'd think that I might make more mistakes on the live stream, or it's more likely that I'm going to say something stupid like that. Uh, I don't know. It is actually easier for me to do live streams in some regards. First person on, let me know if you guys can hear me all right. I'm curious to know about that. But anyway, let's talk a little bit about what the markets are doing today before I jump into some very specific content that I wanted to cover on EVs, Teslas, and a couple of other players that are getting into the business right now. So, look, markets were doing fairly well today. The S&P 500 up 2% right at the bell here. Dow Jones up 434 or 1.3%. The Nasdaq 100 up 321.55 points or 2.6%. So that's a good day. Gains were paired a little bit after some comments by Chairman Powell of the Federal Reserve. Kind of to be expected, though. He's still pretty hawkish on interest rates, saying he's not going to hesitate to sort of break out of these like neutral quarter point raises if the need arises, and that's good. I think where it's time that we hit that stage right now. Um, a lot of stocks that were down pretty heavily last week are back up this week. Affirm, Upstart, Sofi, basically all of your fintechs are up pretty far this week. The VIX, which is a measure of stock market volatility, is down a little bit at this point, but almost every major index right now is trending below baseline, except just barely consumer staples and, of course, energy. So energy up 52% in 2022. Everything else was down except consumer staples, and those are up by like 1.8%. So if you're down at this point this year, I wouldn't feel too bad. Most people are. So let's talk about some of the major news that came out today. And this was a surprise early on for a lot of folks. Walmart stock fell sharply as earnings missed and forecast was cut. So in order to properly understand this, though, you'd really kind of need to read into the earnings a little bit and understand what's going on. And I actually kind of find this encouraging, meaning that I think that there's still strong consumer demand for products. The challenges that Walmart is having right now has to do with increasing costs because of supply chain issues. So Walmart reported adjusted earnings of a buck 30 a share on 141.6 million in revenue. Analysts were expecting $1.48 per share, which is a lot higher than that came in at 130, but only on sales of 138.8 billion, which means that they actually had more sales than was anticipated. The sales grew by about 3% year over year. That's more than analyst estimates of 2.4% growth. That's completely in line though with what healthy growth is. But also Sam's Club Warehouse saw comparable sales increase by 10.2%, but gross profit dropped 2.2% due to supply chain costs and markdowns caused by inventory delays. So everything right now is related to supply chain disruption. Early on during the day, Walmart got crushed. It's down 11% for the day at this point. Like I said, it's all because almost everything that they sell in the store is shipped from China at this point. It makes sense that they're seeing increasing pressure on their bottom line, but they haven't seen a decline in sales at this point. I think it's very interesting. Barron's is, which is someone that, this is a company that I get a membership to Barron's that my Patreon members pay for. My Patreon members are really keeping me in the know when it comes to premium news sources, and Barron's is one of those that I subscribe to. So they don't pay me or anything like that, but I do share things that are kind of behind the paywall here. And I think that Target earnings are, just like Barron says, are going to show us a little bit more about how customers are handling inflation. So Target's going to report first quarter numbers on Wednesday. And I think we're all going to be interested to see whether its customers are handling inflation kind of like those at Walmart are. And this article says more easily than those at fellow big box retailer Walmart. But the numbers from Walmart show that sales are still strong. It's supply chain issues that are affecting Walmart's profitability. So analysts expect Target to earn $3.07 per share on revenue of 224.48 billion. What I expect is something in the line of what we saw with Walmart, which was earnings per share a little bit lower and revenues a little bit higher. So that's kind of where my thoughts are today. So let me know if you guys have questions in the comments below about anything going on in the stock market today. I do have quite a bit of thoughts myself that I'd like to share on EVs, on Tesla right now, and a couple of other things. So a little bit of Tesla news right now. Tesla Cybertruck reservations are limited to North America. So I can't be the only one that's disappointed out there that we first had the Cybertruck. I mean, the rumors of the Cybertruck came out sometime in 2016. It was really first announced in 2019. It was supposed to be delivered by 2021. Now we're hearing that we're not going to see it until 2023. Color me disappointed. My wife absolutely does not want me to buy a Cybertruck, but I would really like to have a Cybertruck. That would actually be the first new car that I bought in many, many years. I tend to buy my cars new, pay pennies for them, and just drive them till they fall apart. So there is some big news in the EV market today that's not very obvious, and you actually need to be kind of a chemistry nerd to understand what's going on. So this is big news in a couple of different ways. It used to be said fairly easily and without qualification that Tesla was so far ahead in battery technology, and in particular battery management technology, battery chemistry, manufacturing processes, that it was going to take years and years for people to catch up to them. Well, it's been a few years now, and we're seeing ideas diverge here where people aren't simply following in Tesla's footsteps anymore. We're seeing Mercedes-Benz kind of step outside of what Tesla is doing in terms of anode chemistry. And Mercedes-Benz taps Sila to produce next generation anodes for upcoming EQG electric G-Wagon. So number one, this is a vehicle that's going to sell well to a market that Mercedes already has. There are a ton of Mercedes SUVs that are sold at this point. They're not looking, the Cybertruck, as much as I love it, they are going to be competing with the F-150, and it just doesn't look like a truck. Now, I'll probably end up buying a Cybertruck, but there's going to be a lot of people that end up opting for something like this. I'm not saying it's going to be this Mercedes-Benz Sila, but there are this Mercedes-Benz EQG, but they're going to opt for something like this that looks traditionally like a car that they would have purchased 10 years ago. But this is building off its 2019, Mercedes-Benz's 2019 investment in battery materials company Sila. Mercedes-Benz announced a supply agreement to incorporate the former's silicon anode chemistry into batteries and to offer extended range for the upcoming G-Class, which includes the electric G-Wagon. So why is this important? Because Tesla is going a different route right now when it comes to anode technology. Now, they've talked about using silicon anodes before, but they've also talked about some of the durability issues with that. Sila is a company that claims to have solved some of those durability issues and cycle issues, meaning they don't have the microfractures in the anodes. And this is also going to potentially increase the energy density of these newer batteries produced by Mercedes-Benz by 20 to 40%. So this is big news. It also, not that graphite or silicon, or neither one of these are materials that are hard to come by or difficult to mine or come from politically problematic countries. But these are a couple of different things that we probably want to take a look at here. I think the most important thing is the divergence in technologies at this point. Mercedes-Benz is firmly going off in this direction of using silicon anode technology. And like I said, this article basically claims that there's going to be a 20 to 40% increase in energy density at the cell level, meaning it's not 20 to 40% increase on a car on the road. That's just at the cell level. But between the cell and the road, though, there's a lot of efficiency with electric motors that you don't have with gasoline engines. So there's not going to be that much energy loss. But Mercedes-Benz believes it can utilize this chemistry to store more energy within the same amount of space, thus delivering better range in future EVs without sacrificing size or interior capacity. I think that's pretty exciting news. If you aren't an EV nerd, you might not appreciate it that much. This is pretty interesting. The Citerstand 30 mile per hour electric scooter. If you haven't seen one of these, ride for 200 miles per charge on Delphi's electric dirt bike at $100 off. Interesting. I wonder if they would make that 50 miles an hour. Wow, 200 miles of riding. That's the top 3.0 electric dirt bike. What it delivers, it's rated to go 20 miles per hour on the road and 50 miles per hour off road. And as far as 200 miles on a single charge, and all that comes off, it comes at $100 off its normal rate. I have no idea what the normal rate is. Maybe you guys could inform me what that is. But anyhow, exciting news in the world of electric transport. I can go over some more of that here in the future. Now, out of China, we're looking at a couple of things happening too. NIO hits delivery milestone of 200,000 vehicles. Now, let's put this in perspective here. They've actually absolutely gotten hammered in terms of deliveries. Tesla, for the month of May and for most of the month of April, really hasn't sold much in China at this point because of all the restrictions going on there right now. I don't expect NIO to be much different in that respect. The significant vehicle just delivered is the ET7 sedan. That is their 200,000th vehicle out there. And yeah, so March 28th, 2022, they recorded a monthly delivery volume of 693 units for the ET7, which is not good, but more related to COVID restrictions going on over there than anything else. I understand that is abating. They just made an announcement of some sort about their zero COVID policy. I'm not going to make any comment on. I'm not going to make any comment on that. Like, my channel is not about commenting about COVID or anything. It's really about stocks, investing, electric vehicles, cool technologies, that sort of thing. So, so I'm here to answer any questions you guys might have about what's going on in the world of finance today. I'd be happy to take a look at some stocks that you guys have questions on. I've consistently had questions about Joby Aviation that trades under JOBY. And so I haven't done a really super deep dive on them lately, but I did do a little bit of research on this company recently. Um, I did do a little bit of research on this company recently, and I'll say that from their financials and from their quarterly releases and earnings and all that, there's nothing to be gleaned out of that. We can't tell anything about that. What really needs, excuse me. So what I need to see is, and what I need to do really is a deeper dive on the technology itself and see if anything has really changed over the last couple of years since I have taken a look at this before. So Joby confirms revolutionary low noise footprint following NASA testing. And this has been my biggest worry, is that, I have neighbors that have drones and those are loud enough. I don't want those around my house, right? And especially we have drones, or not drones, but vertical takeoff and landing vehicles that are large enough to move human beings. They're going to move a lot of air. But yes, Elon, sorry. Like I said, I haven't done a deep dive on the technology as of yet. This is what I'm still looking to do. But I took a look at the surface level stuff in terms of their financials and their releases, and there isn't a ton to be gleaned from there. They're still kind of a science project in this respect, right? So, which is not 100% terrible. There's a lot of companies that we invest in that were science projects at first, and not necessarily real companies. When I made my first investment in Tesla, you could not say that they were a real company, and you honestly couldn't really say that investing in Tesla was a really smart idea until about 2016. So Michael Will says Costco was down today. Was that in sympathy with Walmart? I'm going to say yes, largely because I can't recall seeing any Costco specific news today. Tomorrow's earnings with Target are going to tell us a lot more. Well, it was down less than 1%. That's kind of within the normal bounce around range period for Costco. I wouldn't glean anything out of that. But I do think that if Target's earnings are down tomorrow as well, and we see, so the issue with Walmart is we had actually increased revenues, but less in the way of profits because of increased costs associated with supply chain issues. I suspect we're going to see the same thing with Target. And if that happens, I expect a little bit further decline in Costco wholesale prices, or Costco wholesale's price. You may even see a little bit of a bounce back from Walmart tomorrow. I think people are going to digest the earnings once they take a look at it. They're going to digest it and come back, and they're going to decide it's going to look quite a bit better. So, kind of some of the other big news is actually Home Depot. I'm seeing this over here on my watch screen. Home Depot has increased their guidance. They think that folks are going to be spending more money in their stores this year than they did last year. And it seems a little bit counterintuitive. But that is one of the things that seems to have been, and it's kind of a new phenomenon, is that whenever we see a little bit of trouble in the economy, Home Depot tends to do a little bit better. The explanation, of course, is that people, instead of hiring people to do work, they're doing all the work themselves. I think it goes a little bit beyond that, is that people are doing a lot of this work themselves to distract themselves from their problems as well. But yeah, so we actually have encouraging news on the consumer front, which is, like I said, we're seeing pretty good evidence that consumer demand for things is still pretty strong. So, as I'm going through kind of the headlines from Barron's here, um, and this is actually, if you're subscribed to Barron's, this is actually coming under my advisor sort of uh, heading here. So you can choose different topics that you are interested in. If you're a licensed advisor like I am, you can choose a bunch of other topics. And this is one of the things that you guys might not see if you haven't done that. But a lot of folks are talking about a recession now. And are we headed for a recession? And believe it or not, this is still an active topic of conversation. Lots of people think that it's obvious that we're going into a recession, right? But we've really only had 7 recessions or so, like real recessions, I think, since World War II. And but we've had numerous scares and numerous times that people absolutely thought we were going into a recession, and that's not always true. And there've been a couple of recent scares, like there was one in 2014, there was one in 2018, there was one in 1994, there was another one in 1998. These are all ones that I just remember off the top of my head, where everyone I knew in the industry was, or who was an investor, was convinced we were going into recession, and it didn't quite happen then. It happened a little bit later. So a lot of folks right now are talking about some really boring and dull things when it comes to the economy. I mean, really boring things. And fixed income. Like right now, most big fixed income traders are staying with very short durations. You can get a 1-year muni bond yielding over 2%, which a lot of people feel that's a good play. It may actually outperform the stock market in the same 1-year time period. And this particular advisor, Holly Newman Croft, is keeping all of their investment grade portfolio really short duration. They like floating rate bonds. Floating rate bonds are something that have not been popular since the crash of 2008, which oddly enough, floating rate bonds actually didn't perform all that poorly in that time period in terms of actual defaults, but they got crushed in the open market here. And something that they don't think is going to be punitive in this type of environment, because it's already been discounted, meaning that all of the interest raises in that have already been discounted. And when you're looking at floating rate bonds, there's this whole credit quality issue inside of there. So within equities, they've been focused for quite some time on high quality securities, as well as securities that have proven they can grow their dividends. So what does that probably mean? That probably means something like dividend aristocrats, companies that have, raised their dividend consistently for 20 or 25 years. So traditionally, dividends have made up, in the past, not in the last 25 years or so, but in the past, dividends made up about 40% of the total return of your portfolio over time. So dividends today are about half what they were prior to 1994. They're about 1.8%. Dividend average on the S&P 500 is about 1.8%, right? That's about half of what it was in the past. It was closer to 4%. So we're seeing that we may be seeing that investors are going to demand higher dividends out of some of these larger, more established companies going into the future. We may just see, because of share buybacks and increased dividends, we may see this flight to quality. Although today's big winners were technology. Let me see here. Can you cast an eye over GAN, a B2B software as a service company? Earnings came out yesterday. Share prices tanked, stock dilution, but a good BMD and expanding team. Let me see. I haven't taken a look at this company yet. me see here. Let's take a look at them real quick and see what it is that they do. Ooh, and I'm going to get to Ryan Longwood. I'm going to get to your comment here in just a minute. So GAN Limited reports Q1 loss, tops revenue estimates. So it's missed revenue now for 4 quarters in a row. Although you do see increasing, it's missed earnings rather, but you do see increasing revenues, including a pretty big increase last year and a narrowing loss in that time period. So that is an encouraging thing to see. We see here earnings call transcript. You see, I don't know a ton about what this company does. I can say it's not, numbers aren't terrible at this point. So a quarterly loss of 9 cents per share versus the estimate of 10 cents per share. Yeah, that's a significant improvement. Shrinking loss here. Earnings surprise of 10%. A quarter ago, it was expected the company would post a loss of 13 cents per share. And they actually produced a loss of 20 cents per share, delivering a surprise negative 50%. Okay. You see here. All right. So this is a wildly unimaginative article. It looks like it was probably written by an AI. Absolutely obsessed by the numbers. Nothing about this jumps out right now that would be like severely negative, other than the fact that it's missed earnings. But you can't always pay too much attention to earnings. Now, when it comes to dilution is not always a terrible thing here. If you look at there are a number of companies that have used dilution over and over and over, through secondary offerings, or particularly what we're going to see going forward, I think is going to be convertible securities again. A lot of those have used a lot of companies have used those to expand operations, and it's not as common with a software company as it is with a company that needs a large amount of capitalization, meaning they need to build factories or something like that. But it does happen. You see here, and cash flow. No need to look at balance sheet. This is a brand new company, basically, or new enough in terms of their earnings here. So looking at investing cash flow. Okay, that's good. And cash position, fine. Financing cash flow, interest. Okay, capital expenditure, payment debt. Nothing that jumps out at me as this is not a company that I'd necessarily jump on today, particularly if they're talking about dilution when they're at $3.63 per share. And let me see what their stock price has done in the last couple of months too. It's not a company that jumps out at me as a hugely solid investment. And you say that they have a expanding total addressable market here. Whoops, what's going on here? You see they have an expanding total addressable market here. Let's take a look at what it is exactly they're into here. All right, so I got a slow internet connection again. So Ryan, let's take a look at what's going on here. And I want to highlight your comment here. I want to talk about this. All right. So, okay. Can you guys see the comment up there now? Ryan Longwood's comment. So, Ryan Longwood says, I lost half my new house payment money on the Luna Ponzi scam. Wife snapped. Never again with cryptos. Okay, man, there's a lot of layers to that comment. And I want to say something about crypto in general. Roughly 17,000 cryptos out there. A lot of them, a substantial portion of them, maybe even a majority of them are actually just scams. A substantial minority of those, and I can't put an exact percentage on it. Let's put an imaginary one. Let's say probably 40% of the ones that are left really don't have any purpose other than to make money, meaning that they're not substantially different than any of the other so-called Ethereum killers that are out there. They don't have anything that makes them different than anything else. And Luna was certainly one of those, but it's not obvious to you. And like, this wasn't obvious to me a year ago. It took somebody that I knew really getting heavily involved in the world of crypto and the world of blockchain technologies to dive into it over months and months and months before he came to this conclusion and kind of convinced me that it was the truth. So I would say that if you're gonna invest in cryptos, you in cryptocurrencies, you need to be prepared to lose all of your money, right? If it's not a Bitcoin or an Ethereum or possibly a Solana, something like that. I'm not even going to go any further. I was a big fan of Algorand, and they've actually gotten crushed this year too. But I have never had more than 2 or 3% of my funds in cryptocurrency because to me, it's just barely an asset class. It's a little bit better than just pure wild speculation. So, and what's going to change that is wide adoption and use and in the actual financial network. So, I want to take a little bit of a gander here at what GAN Limited actually does. This is a B2B supplier of enterprise software as a service solutions to online casino gaming and sports betting applications in the United States, Europe, Latin America, and internationally. Operates on two segments, B2B and B2C, and licenses GameStack, an internet gaming platform that provides turnkey technology solutions for regulated. That's why they had like a director of regulation. Okay. Not all companies have one of those. So they have like a director of regulation, probably just negotiates regulation and a bunch of different things. So, yeah, there are quite a few people that have brought different gaming companies to me. Just from a quick look, I don't see anything that stands out about this company as being absolutely a must have. I will say that trading volume at under 1 million is kind of concerning. Meaning it's not a very robust market. I mean, it's still it's almost 600,000. That's not terrible. It's not like there's less than 10,000 shares trading a day, but there isn't even 1 million shares trading a day. That could be kind of concerning. But they don't have any like regulatory red flags that are out there. Very small market cap. The total addressable market you say is expanding, and as each state legalizes gambling, U.S. market increases. Yeah, that's true. That's true, and I think eventually almost all states are going to legalize gambling just because they don't want to miss out on the potential tax revenue. Just like almost all states are going to eventually legalize weed because they don't want to miss out on the potential tax revenue. Have you guys seen like you have sales tax? In California, you have like a 10% sales tax plus a 25% excise tax. I think it's 25% on any products that are sold through a weed dispensary. And it's gotten so bad that maybe the guy who sold weed on the corner can't make it anymore. But now you're seeing illegal dispensaries pop up everywhere. And it's absolutely amazing. So uh, Eric M says, how much time do you spend learning? I spend all my time learning one thing or another, and I have a wide array of interests. But and my consulting work that I do in the financial industry doesn't usually take up that much time. It's just taken up a little bit more time lately. But I actually just like researching companies, even if I never invest in them. I like researching new technologies. But I'm a Brazilian Jiu-Jitsu black belt. I just finished building a boat from scratch. I'm always learning something new. It's my next thing I'd love to do is write a science fiction novel. I've never written a novel, but I'm always learning something new. I learned a long time ago that the folks that became sort of static in their knowledge are the ones that got old really quickly and got very uninteresting. And and I didn't think they enjoyed life very much. Being a lifetime learner, I think, is one of the keys to enjoying life for your entire lifetime. So, I spend pretty much all my time learning, and I don't really sleep very much. So, yeah, that's a very it's a very bad explanation as to why I have so much general knowledge and can talk all day about stocks. It's because I'm obsessed with basically finance in general. But I'm a certified financial planner. I've been involved in the financial industry now for close to 20 years. And before that, I was actually involved in the finance industry, but from a IT perspective, from a programming and forensics perspective before that. So for a long time. So when you research a company, I'm sorry, I'm having trouble with my software again today. When you research a company, what are things you're looking for? Are there something like a top 5 things that you're looking for? Um, Okay. Yeah, there are. So, and this has evolved over the last couple of years. One of the things that I don't find as, and let's talk about what I don't find as important as I used to, and it's the people that are in charge of the project. I want to see that they have the background that allows them to be. Well, so one of the things that impressed me about Elon Musk is and lately I've been far less impressed by him. But one of the things that impressed me that he said a number of years ago is that far too many companies are run by MBAs and not by engineers or people who actually understand the technology that they're investing in. And I think that's true. So I look for a CEO that's well versed in the actual technology, usually has like an engineering background, because I tend to do mostly uh tech investing, and everything that's not tech investing I'm happy to hold through an ETF, because I don't think you can beat the market. Like if you're, I don't think you can beat the market if you're going to buy Chevron over Exxon. I don't think there's no point in doing that. You might as well just buy an energy ETF, and you can go so far as to say that for most of what happens in U.S. markets, you're better off just buying an S&P 500 fund. When it comes to technology investing, though, there's a few things I want to look at. I want to see that, number one, they have a CEO or a visionary that understands the technology they're working with. Number two, I want to see that they have a staff that can do the really boring things, right? Meaning they have, your CFO who's been around the block before, who's taken a company public. Super important, right? Super, super important. You want to have someone who understands industrial engineering and everything associated with supply chain issues and manufacturing things. Like when it comes to anything in the automotive industry, I love to get Sandy Monroe's opinion. Right? If you don't know who Sandy Monroe is, he's an engineer out of Silicon Valley who like reverse engineers a lot of things and talks about industrial processes a lot. And he's done a lot of work reverse engineering some Tesla vehicles and anything else sent his way. And he's just this. He kind of reminds me of my grandfather in a lot of ways, but he is actually gives you a very good idea as far as which direction a company is going in terms of technology. When it comes to that boring piece, you want a CFO who's been around the block, who's taken a company public before, and understands how to negotiate capital markets, how to raise money, and that's one of the things also that Tesla has been expert at. They have been an expert at going back to the secondary market over and over and over, and hitting up investors in terms of a secondary offering and selling more stock and constantly diluting, right? As soon as they went public, they pretty much diluted every single year. I think there was 1 year that they didn't dilute. They either did it through convertible bonds, which they're a huge fan of, or by secondary offerings. And it takes skill to manage that without everyone always constantly talking to you about dilution. And so those are kind of the two big things that I look for in terms of like uh, in terms of personnel, right? Now, in terms of process, what I'm looking for is a technology that looks to scale into the future. Meaning, I don't want someone who's going to do something that already exists today 10% better. What I want them to do is to open up a whole new market into something where you're getting the means of production like completely changed. This is one of the beauties of capitalism, and one of the things that Karl Marx, when he wrote the Communist Manifesto, never could have predicted, was that the means of production were constantly going to change. And in that, you're in a capitalist society like the United States, at least. I don't know so much about Europe. You are constantly going to have a cycling of wealthy people going from shirt sleeves to shirt sleeves, meaning that the economy is going to change so fast that people who were wealthy 2 generations ago, their children were back doing blue collar jobs, because so much had changed about our economy. And this is one of the reasons why you should never be investing for what happened 10 years ago. The companies that have been, everyone talks about the dividend aristocrats. Yes, I'm sure I own a bunch of the dividend aristocrats through the DGROW, which is a dividend growth fund that I have. And I'm expecting linear growth out of that fund, 7 to 8% per year. And I have that there to cushion the volatility from my technology portfolio. My technology portfolio is where I've made most of my gains and most of my losses too. Okay. So let's be honest. There's some of those that I've gotten crushed in and never recovered. 3D printing is one of those. So that's the other part of the process there. And I kind of lost track of what I was talking about. Oh yes. The sort of transformative technologies. So I didn't really have a word for it or a way to conceptualize this until I started listening to Kathy Wood. And it's not that I just listened to Kathy Wood. I went back and I sort of read the foundational texts for her philosophy, which is Craig Christensen's Disruptive Innovation. And I realized that disruptive innovation in the technology world does not happen in the way that Clay Christensen describes it, right? It happens kind of in the opposite way. Instead of starting off from the bottom with neglected markets, most companies, and Tesla is the best example of this, they started off selling a product that they knew had limited appeal, but to a real high dollar market. Meaning they sold a car that started off retailing at $160,000, but had massive margin built into it. And it was really for like well-heeled gadget geeks, people who really just wanted to show that they were, green, right? And somebody got really offended when I called the first Tesla buyers just green gadget geeks. Um, that's what they were, and they were just wealthy people who wanted to show that they were environmentally conscious and wanted to own a cool product, and they were willing to pay $160,000 for it. That funded in part that next walk down the value chain so they could produce a cheaper vehicle that would appeal to a much wider audience, that would have slightly less in the way of margin. But as you're building these vehicles and so Kathy Wood's philosophy, of course, was combined Wright's law combined with Clay Christensen's disruptive innovation. I think Wright's law is far more important when it comes to Tesla and when it comes to electric vehicles in general. It was bringing the cost of the lithium-ion battery down through Wright's law, meaning that for every cumulative doubling of manufacturing, you had a rather predictable reduction in the overall cost of manufacture because you simply got better at manufacturing, right? That was kind of the key there. And I'm looking at now other industries where we could see Wright's law really start to have an effect. And one of those is in genomics. And this is kind of the issue with genomics, though. This is one of the reasons why I hold this entire field, in an ETF rather than individual. So individual stocks, is that as much as I see the cost of some of these technologies coming down, and as much as I see how revolutionary they are in terms of the insights they can give you into gene interaction, how those insights are monetized still isn't clear. And this is the problem I have with taking the dive on any sort of individual company in the genomic space, right? So there's a lot to consider before I dump my money in any individual company. It's far easier for me to invest in a physical technology where you're selling a product, or to invest in like a financial company, which is something that I understand really intimately. Much chancier for me to invest in something like AI, for example. I don't know where AI is going to go in the future. You don't know where AI is going in the future. We all do. I mean, I would really love for there to be an AI ETF aside from ARC's, AI ETF or automated technologies ETF. So a lot of things going on there as far as what I look for when I'm investing in a company. I tend to write down the list of pros, write down the list of cons, and what's more important is a third list that I write down is the list of things I have no idea what the hell is going to happen. Right? Very, very important. Okay. Okay. I don't know how I got on this page. Anyhow, so super important. And yeah, so I think, let me see here. I'm going to move on here to a different question. Do you think the S&P and markets are bouncing along the bottom, or do you see it going down further? I see a bottom, and I didn't agree with this when I first started taking a look at it. I see a bottom at around 3,800. That's not my bottom, of course. That's the bottom that a number of financial firms that have come out and talked about it recently in some of the industry meetings that I've had. They're saying now 3,800 is probably the bottom, and which would represent, which means in terms of technology investing, we're probably already there, right? And so I see it going down further. I think it's going to bounce around the bottom for quite some time. We have quite some time before out of this volatile period. And I said this before on another live stream that the one answer that no one wants to hear about the cure for inflation is time. It's going to take time for the supply shocks to ease, and things are not any easier now because of the war going on in Ukraine. That we haven't even begun to feel those supply shocks yet. We're going to see those later on down the road. So I don't actually see, if we see significant improvement in markets before the end of the year. I think that at some point the market's going to get the knees chopped out of it from under it again. So right now, there's a number of stocks that I was trying to acquire. Upstart was one of those. I bought a few shares at like $26, $27 a share, and immediately has jumped up to like $39 a share, which is 3 months ago I would have considered that one hell of a bargain. Today it's probably still a great bargain if your time horizon is long enough. But man, I was hoping that I would be able to get into this a little bit quicker, and then I would be able to get a full 100 shares in order to be able to write cover calls on that as it went up. But yeah, so I feel like right now I'm missing out on some opportunities that my opportunity to be a vulture over the last 2 days has kind of gone away. Some of my most watched stocks have gone up really quickly. Yeah, so I do think we can go down a little bit further. I do think 3,800 or so is probably the bottom. I do think we're going to bounce off of that bottom a couple of times this year, and that we're not out of the woods yet. So, some all parts of valuation, Amazon Web Services worth the market cap of Amazon, meaning everything else is free. My sum of all parts valuation has Amazon Web Services worth the market cap of Amazon, meaning everything else is free. Wow, I have not thought of it that way, and I think that that's an interesting perspective. I should consider that a little bit. Amazon Web Services is probably worth more than the market gives Amazon stock credit for. I think you're absolutely correct in that. I don't know that it's worth more than everything else, particularly in light of what Amazon is doing in terms of securing its own supply chain and the fact that it delivers everything to everyone these days. And so I don't. Yeah, that's an interesting way to look at that. I think that's quite interesting. And Frantic Pillow here says I'm 40% in stocks in the moment. PayPal, Facebook, Xbunk, Spotify, Tesla. The rest 10% is ETFs and 50% in cash. Am I doing a mistake in being heavy in stocks? My portfolio is like 20% at Facebook and PayPal. So one of the reasons I talked to a lot of people that are down a lot. So my overall portfolio is down a little bit more than 10% at this point, like 11, 12% at this point. It's cushioned by the fact that I have a lot in just ETFs, index ETFs, and I have a lot of and sort of legacy stocks that have done well. Like I used to work for the energy industry, so I have some positions in the energy industry, and those have done really well this year. But most of the people that I'm talking to, particularly one or two clients that I've gotten from this YouTube channel who've come into my private practice, I'm looking at their portfolios and they're down a lot more than 10 or 11%. They're closer to 30 to 40% down. And most of that has to do with a lack of diversification. Now, a lack of diversification is okay when you don't have a lot of money, because that's one of the ways that you can make money rather quickly. But when you have a decent portfolio, of $500,000, $250,000 or something like that, you really want to start thinking about diversification. Taking backward steps when you have $500,000 hurts a lot, right? And a backward step when you have a lack of diversification, if you have $500,000 and you lost 20%, you just lost more money in the last 3 months than most people earn in a year. Now you hold, it's going to come back eventually, but it's hard to sit and eat those losses when for some people, it's hard to sit on those losses and eat them when you have higher net worth, right? Now let's talk about this. I've been an investor in Tesla for a very long time, so I'm used to having a lot of volatility in my portfolio. I've also been a technology investor for a long time, so I have a lot of volatility in my portfolio. My reaction to most time periods like this is no reaction, or I go out and buy more. So the last 2 times we've had a market crash, I got lucky and happened to be sitting on a buttload of cash right when things went to hell. It happened in 2020. And I wasn't expecting that 2020 to be sort of like a generational opportunity. I knew that I was going to make a quick 30 or 40%. It turned out to be more than that, but I knew it was going to happen, right? This downturn right now, I think you're looking at this being a huge misallocation of capital, particularly when it comes to fintech stocks. The problem with fintech stocks is choosing winners. I do think that I think that a number of traditional finance companies are moving into fintech right now in a big way. The biggest one is Amex. They really seem to be catching up with all of the different technologies that are out there. But fintechs, for cultural reason, are going to be pretty successful peeling business away from traditional banks here in the future, just for cultural reasons. People are tired of banks. If they can choose to do business in a different way, they will. Right. And my last holdover with traditional banks right now is business services. I own a number of businesses that are retail where I have to have a relationship with with them. I would prefer to do everything through Square, although I forget the bar that I own. I forget the name of the software package that we're using. Toast is what we're using for that. So that's really interesting. I don't actually own Toast stock, but my business uses that software to manage the bar. And we're kind of spinning off possibly a food truck business here at some point as well. And I want to see how that works for that too. So let me see here. Let me go back to this question though. Am I making a mistake by being so heavy on stocks? I think you're making a mistake right now, not being so heavy on stocks, but being so heavy on cash, unless you've already got a strategy to dollar cost average your way back into the market. Now, I don't know if you sold stocks recently and got out. If you're trying to do that for like tax loss harvesting, or you're trying to just lock in some gains here. But your cash right now is losing money, and it's losing money at a faster rate than we've seen since the early 1990s, like 1991 or something like that. So, yeah, I say that you may want to rotate some of that cash into quality stocks that, like I said, that maybe not the best stocks of the last decade, maybe not even the best stocks of the next decade, but you're looking at consistent performers excuse me, that are going to do well in all sorts of different economies. So I've heard that China is investable many times recently. Makes me want to invest heavy. Eric, where are you hearing that China is investable? So I own a number of Chinese stocks traded here in US ADRs. I hear most often there that China is uninvestable. It's not for the faint of heart. I'll tell you that much. I will say one thing though: the delisting concerns we have with ADRs here are very real, but the negotiations going on behind closed doors are all being done in good faith. Meaning, it's not. And Chinese media is reporting the negotiations over reporting requirements for stock exchanges here. They're actually reporting this in a really professional, neutral manner compared to what's going on here in the U.S., our media here in the U.S. So I would think that we are going to come to a negotiated solution in that. You are always getting a bit of a discount when you're buying a Chinese stock because it's Chinese stock, whether that's, and I think my opinion is actually entirely justifiable. There've been so many companies that have actually screwed over U.S. investors from China more than are actually traded on U.S. stock exchanges. So, yep. Good question here. If your time horizon is 10 to 20 years, why don't you just load up on leaps, with deep in the money leaps, 1 to 2 years out on SPY instead of just holding the underlying? That's actually a very good question. I do tend to buy leaps on individual stocks. I don't tend to do them on the index, and that may be a strategy that I do. I mean, it's no recourse leverage. It really is, and especially it probably makes a bit more sense on on something like the S&P 500, especially right now. Like, why wouldn't you do it right now? Like, I can't guarantee it, but I think it's 95% certainty that if you bought a leap out 2 years from now, deep in the money leap, that you're going to be very happy 2 years from now. Now you may have to exercise at that point because there might not be a market for it 2 years from now. And that's not a bad thing, guys. All right. So you may have to exercise because it's so deep in the money that there's just that market is so thin because most of them have been exercised already. So yeah, that's not a terrible idea. But typically when I buy leaps, and if you guys don't know what a leap is basically just a deep in the money call that's set where the expiration is more than a year out, right? So it's a way of using leverage in a way that can't come back to bite you in the butt, like having like borrowing money on margin, right? The downside is, let's say I bought a bunch of calls for $10. I think they're January 19th, 2024 on Sofi. I bought those a few months ago, and I am deep in the hole on those leaps, right? Deep in the hole on those leaps. So what did I do? I went out and bought a bunch more, right? A bunch more for a couple of different reasons. Number one, like I said, it's no recourse leverage. But number two, what are the chances that SoFi is not going to be worth more than $10 a share, 2 years from now or a year and a half from now? I think the chances are actually fairly low. I think it's going to be worth significantly more than that, meaning that those leaps when I bought them are originally deep in the money, and now they're not deep in the money. They're out of the money. But I still think that the chances of them being in the money and deep in the money in the next year and a half are pretty high, right? And Hawk sent me in a $10 super sticker. Thank you so much, sir. I don't necessarily do this for the rewards from super stickers, but I do actually really enjoy that. So, this is something we should probably talk about more. Is leaps. If you are concerned about market volatility right now, you took a huge loss getting out of stocks right now. You want to get back in. You don't necessarily want to buy at these levels, but and you don't necessarily want to deal with volatility at these levels, but you really feel like things are going to be much better a few years from now. I'm telling you, buying in the money leaps right now on high quality stocks. I'm not talking about the high volatility stocks that we like on my channel. I'm talking about high quality stocks like Microsoft or Johnson & Johnson or anything else that's that's a blue chip stock that has lost money recently. Anything that's basically in this consumer staples group right now that's down. If you were to buy something in the consumer staples group right now, you can look through. There's a number of different indexes that are out there. I think you do fairly well. You buy in the money leaps that are 2 years out. You wait the 2 years to either exercise or sell those leaps. Number one, you're going to pay long-term capital gains on that if this is at a taxable account. Number two, you're going to magnify the return that you have while not using up all of your purchasing power too. And you want to do this when the market is down. It's much better to buy leaps when the market is down, anticipating that 2 years from now, almost everything is going to be hunky-dory. And your risk, of course, is the premium is what you pay to purchase that right now. I have, hold a second here. New York's Eric M says, New York Stock Exchange's best day performances happened during the Great Depression crash, and NASDAQ's best days happened during the TMT crash. What are we calling the TMT crash? Yeah. So, yeah, actually the best performing day I think for the New York Stock Exchange was actually, and that was true in the past, but I actually think recently that was broken in 2020 during the pandemic. We had a day where the market was down like over 2,000 points or something ridiculous like that, and then the next day was up like 2,200 points. So very, very interesting. And okay. But anyway, Hawk, that's a really interesting question. Why don't you just load up on deep in the money leaps on the S&P 500 index? Really good idea. I think that right now is actually, in terms of timing, that could be a fantastic idea. You see here. All right, you're going to clarify. New York Stock Exchange's best one-day returns happened during the Great Depression crash, and NASDAQ happened during the TMT crash. Yes. It's like I said, like I've said before, the worst days in the market and the best days in the market, depending on which market you're invested in, still tend to happen pretty close to each other. That's one of the reasons that folks always say time in the market is better than trying to time the market. And because your days that you actually hold on to those gains are pretty rare. Over a 20-year period, in most cases, there may be 10 days at a 20-year period where you really hold on to the gain. I know that sounds really weird. Go Google best 10 days of the market. You won't regret it. That research, well, maybe you will if you don't like numbers. Like, you look at a guy like me, I've never seen a chart that I didn't like. So a couple of other things to look at right now. We have a lot of inflation going on, right? Worldwide, ton of inflation. US dollar seems to be losing money. It's not losing money, actually. The Japanese yen is trading at its weakest level against the dollar in a very long time. So my family goes back and forth to Japan every year, so this is something that I keep track of. It's very weak right now, which means that our exports are fairly expensive over there. Their imports to us are kind of expensive, or our exports to them rather are less expensive. The euro is at $1.05, which hasn't changed that much in the last year. Bitcoin, I wish I'd stop putting this in currencies, but it's at 30,000. And we may be in a crypto winter at this point. I don't know if we are or we aren't, but I have set my auto invest on, and I'm not going to think about crypto, making any large purchases of crypto right now. I'm just making a couple of auto purchases right now in Bitcoin and Ethereum and Solana. And I backed off on Algorand just because I already have a bunch of Algorand. But yeah, so any questions you guys have right now? Emerging markets have actually gotten crushed lately. They did fairly well today. Developed European markets are up as well today. There's all across the board, all around the world, markets were up today. And not only that, all across different U.S. equity factors, meaning growth, core, value, small, large, mid cap. Basically, everything was up today. So you weren't a genius in the market today. Because basically it was a bull day and everybody's a genius in a bull market, right? So, questions, anything you guys have? If not, I'm going to continue talking about things I like to talk about. Let's talk about this company right here. So I've been looking at Upstart for a while, and I'm going to be honest with you. I looked at Upstart 6 months ago, 7 months ago, and it was a little rich for my taste. When it got down to like $100 a share, down from like 300, I was like, wow, in terms of future earnings, this company doesn't look so bad. I started thinking about buying something. The only reason I didn't is that I didn't have the money available to do it at the time. It had already been allocated to a few other things. So, like I said, I bought just 10 shares. That's all I could afford. And I bought it last week, and I bought it, at like $26 a share. So basically, it is up 23% today. Prior to its earnings, it had crashed down about $44 a share right before its earnings. After earnings was released and the market opened, it dropped down into the 20s last week, and now it's back up above that pre-market earnings. I think it was actually like $77 a share. At $77 a share like 2 weeks ago, I was thinking this was a great move for the future. Now, when they released earnings, their earnings actually blew it out of the park. And it was absolutely fantastic. Absolutely fantastic in terms of revenues here, and in terms of what they expect. Now they have compound annual growth of 187.56% year over year, right? So that's actually, hold on, that's not correct. So basically $577 million, compound annual growth of 250% year over year. So hugely important metric here. They beat on revenues, they beat on profits. What they reduced a little bit going forward was their guidance, right? They only reduced it by about 15%, and that caused absolute panic, and people dumped it left and right. And I managed to pick up a few shares. This is really buying on the dip. And I made that video last week, buy on the dip zombies. And literally that's what I was thinking of was Upstart. I know people are tired of hearing buy on the dip, but this is a company with growing revenues. They're a profitable fintech, which is really, really rare. Like Sofi is not profitable, and they're not going to be profitable for a number of years. It took a long time for Square to be profitable. It took a long time for PayPal to be profitable, although PayPal really started in a different era. MoneyLion is not profitable, but they are having both Sofi and MoneyLion really kind of hit earnings out of the park. But they both reduced guidance here. So a lot of these companies are looking pretty good at this point, particularly fintechs. Like I said, the huge misallocation of capital when it comes to fintechs. This is the reason why these companies are still growing their revenues. They have real revenues. There's less hype than you might think around these companies. Like a lot of these companies are profitable, or they already have a pathway to profitability. Like Sofi has a pathway to profitability. Upstart is already profitable. Affirm is another one of those companies that I'm looking at, and there's a few others that I just can't think of off the top of my head right now. So Bram says, "Hey, better late than never. I'm still hodling Tesla, man." So I'm not a TikToker, but I do have a TikTok account, and I've been watching TikTok lately for some Ukrainian creators on there who've been reporting from the war there, and I realize that I'm getting propaganda fed to me, but still, it's been entertaining. But I also get a lot of like crypto bros on there too, talking about hodling, and there've been a couple of videos with people actually crying, um, because they lost money on Luna. Now, I don't want to make fun of people that lost money on Luna, and that holding on for dear life is not the best strategy. I'm a long-term holder of a lot of things, but holding on for dear life to something that is purely a speculative play is not necessarily the best way to go. I wouldn't consider any cryptocurrency a solid investment. It's one that you need to keep an eye on at all times. And I watched one video where a guy lost over $1 million. And I don't know if it was real or not, but he was in tears the entire video. It made me super comfortable. So Olarende Ajay says, where does Upstart uniquely differentiate itself from SoFi? So Upstart's business is much more limited. They really just loan at this time. They don't have a ton of other lines of business. They do, but they're a lot less significant, and they don't have the fully fleshed out strategy that SoFi does. So that could hurt them in the long run, but it could be beneficial as well. Specialization is for insects, but there are a lot of insects that are really good at one thing and have managed to avoid extinction for a long time. Think of the cockroach. Oh man, like comparing Upstart to cockroaches. But that is not necessarily a terrible strategy. Being good at one thing can be a good way for a company to go. SoFi's strategy is completely different. They have this flywheel strategy where they want to suck you into an ecosystem. They want to keep you there by making the relationship really sticky. And so very, very interesting. But I'm not saying that this is going to replace my SoFi investment. It's definitely not. The Upstart is a company that I just started purchasing. So anyway, I'm actually getting emails from work right now, which is kind of crazy. But so thank you, Hawk, once again for the super sticker. I really appreciate that. Let me see here. Any other questions you guys might have? Let's move on and talk about SoFi. Let's talk about SoFi just in the last week or so. SoFi is probably one of my biggest disappointments as an investment in the last couple of years. Such a great company in terms of a revenue growth story. The market does not believe in SoFi at this point. And let's talk about that. Over the last year, they went public and went quickly up to $22.40 a share, dropped down here to 16, back up to $22 a share, and now they're down to 705. And earlier they were down to 612. I want to say, and these are just closing prices, I want to say that they got into the fives at one point. I stopped looking because it was so discouraging, but they got in the fives, and now they're back up to $7.05 a share. I'll probably be purchasing some more SoFi this week, and I have some money coming in. I'll probably purchase another 2,000 or 3,000 shares of that. Extremely long-term hold for me. I also have, like I said, the leaps going out. I think I have 10 leap contracts. Maybe I have more. Yeah, I'd have to take a look. But 10 leap contracts going out on SoFi. Not for the faint of heart, folks. And it's going to take a while for, like I said last live stream, I think that the market has sort of discounted SoFi a little bit more than is justified. Take a look here at let me see here. Revenue growth, which is always important for me, is revenue and growth. SoFi is a solid growth story. They have increased their earnings every quarter since they went public. Let's look at September. Well, this is even before they went public. September 30th, 2022 or 2020. Every quarter since then. Last quarter here, we're looking at revenues of 6.86 million. a compound annual growth rate of 60% year over year, which is less than an Upstart. But yeah, so they have a lot more in terms of lines of business. They have the entire software suite. They have banking that they actually have a banking charter, and talking about the software suite, and they have their lending arm, of course, and they have their financial services arm. So they're expecting probably more growth in financial services, in banking, and in their technology arm this year than, of course, they are lending. They're expecting to be hurt by the moratorium on student loans. And let's talk about what this is. This is not an example of Sofi or any other company that refinances student loans. It's not that they're unable to collect payments on student loans they've already refinanced. It's just that they can't originate new business, or they can do very little of it because there's no incentive for folks who have these loans to refinance while there's a moratorium on interest and payments. Why would you refinance at this point? Although with interest rates rising now, it seems to make a lot of sense to refinance, right? I think that most of the student debt is probably going to get forgiven. And this would be and it's going to get forgiven when interest rates kind of peak, I think. I think as a political move, as a possibility, we might see a small amount of forgiveness just prior to the elections. I think that on the way out of office, that this administration is going to forgive a huge proportion of student debt, and for a couple of different reasons. Timing wise, it might make a lot of sense 2 years from now, after we've gotten a handle on inflation, that this might actually be the economic stimulation we actually need, which is forgiveness of the debt and putting a lot of these folks who are, because 92% of student debt is actually owned by the U.S. Treasury. So folks who owe student debt are mostly just paying the government back. And why do we want a large proportion? 1.6 trillion or 1.7 trillion dollars is owed in student loans, which is, let me put this in perspective, that's just about as much government debt that China owns, right? That's just about as much U.S. government debt as China owns. That is the amount of money that people owe in student loans. So why would we want the U.S. government to be paid for that? I think that it makes a lot of sense moving forward as a stimulus measure to forgive those payments. And I think that for a bunch of different reasons, practicality and for political reasons, it's probably going to happen. Not a comment on whether or not I think it's right or wrong. It's whether or not I think it's actually going to stimulate the economy and be better for the American economy as a whole. And that I definitely think that it's going to be. Will this hurt their business going forward? Yes. And I think that SoFi has planned on this. And they planned on this, and they started a while ago when the sort of political pressure to forgive debt started. They started expanding into different lines of business to widen out. If you look at personal loans, are a much larger percentage of what they were 2 years ago. Their mortgage business grew last year, but of course that's getting crushed now. I don't know if you guys have taken a look at interest rates on mortgages, but when I looked 2 days ago, it was like 5.27%. And I talked to someone in the mortgage industry over the weekend, and she told me that they have not had a single application for refi since the beginning of April. So no one's refinancing their mortgages anymore. A lot of people are in a house or sitting on 2.75 to 3.75 interest rates. They're not moving anytime soon. They have no incentive to sell. And interest rates going to be high. I think we're going to see a crash in the housing market here pretty soon. Anyway, folks, it's about time for me to go. I do have some things to do in terms of business. I'm going to try and make it on almost every day this week. Probably not Friday. I'm going to go to the beach on Friday or fishing or something like that. And but thank you very much for tuning in today. I want to talk a little bit more about the real estate market tomorrow and the direction that I think that it's going in. And so let's do that live tomorrow as well. I'm going to try and do it once again at 1:00 in the afternoon. So let me see here. EOG says, what will be the material impact of a bank charter seen for SoFi? Do you think yet this year? I don't know if we'll see. I don't know if we'll see it this year, but likely we're going to see it really, really soon. And it's going to be even more magnified because the bank charter was going to help them out when it comes to the spread between borrowing rates and rates that you can loan money for. But they had all of that eaten up with the way their business model worked before, with the fees they had to pay for people to custodian their loans. Now they can custodian their own loans, and they can take advantage of that interest rate spread between deposits and loan rates. So that's going to impact their bottom line in a big, big way moving forward. Not only that, they can actually go out and buy loan portfolios on their own now and custodian those. Meaning that's a big part of any financial institution's business, is actually buying and selling loan portfolios. Like selling these whole tranches of loan portfolios. You know how you buy a house and 6 months later your loan company is somebody new because your mortgage was sold. They can now get into that business because they have a bank charter as well, and that's another way to boost profit. So it remains to be seen exactly how much it's going to impact them in the near future. But when we're looking at 2-3 years down the road, especially with rising interest rates, it's going to be a hugely beneficial move, and it came right at the right time. Anyway, folks, got to go today. I will see you tomorrow. I'm going to try and get back on again at 1 o'clock tomorrow. Thanks. Bye.